Good morning, students. Hope you are doing well. One of the important, the objective of this video to communicate whatever the questions given in recent RTP applicable to November 2022. So my suggestion is every student must prepare each and every question involved in this RTP. So it may useful in upcoming examination. Okay, some questions are very unique. So that don't neglect to prepare RTP applicable to November 2022. Yeah, let's begin our discussion with question number 1. This is the case scenario question. Based on this information, so you should require to answer 5 MCQs. Okay, first let us read the scenario. Whatever the information given in this, it's a purely capital gain related case scenario. So 75% capital gain related, 25% house property related. It's an interest calculation. Okay, so High-Tech Limited, a real estate development company. It's a capital gain related case scenario. That too 45 subsection 5A gets attracted in this scenario. 45 subsection 5A. So High-Tech Limited, a real estate development company, entered into an agreement with Mr. Sakshar, a resident individual. Sakshar, a resident individual, on 25/6/2019, as per which Mr. Sakshar agreed to transfer a plot of land measuring 12 acres in New Delhi to High-Tech Limited. High-Tech Limited. So Mr. Sakshar purchased the land on 14/7/2017 for 80,55,000. So joint development agreement. It's a joint development agreement between landowner Sakshar and the developer is High-Tech Limited. So Sakshar and High-Tech Limited between a joint development agreement. So here the land was acquired by the Sakshar on 14/7/2017 and given to the High-Tech Limited for development activity on 25/6/2019. So this is the purchase date of land. This is the agreement and handed over the land to the developer for development activity. So that is one of the land was acquired by the Sakshar for rupees 80,50,000. Okay. Next paragraph. High-Tech Limited has planned to develop high-rise society 250 flats on such land. So the developer plans to construct 250 flats on such land in consideration. So High-Tech High-Tech Limited paid a part consideration of 1 crore to Mr. Sakshar on the date of agreement and would provide 3 flats in the society to him as final settlement. This is the consideration provided by the High-Tech Limited to Sakshar for development activity is 1 crore rupees cash plus 3 flats in developed property. So that is one of the important information. So let us analysis the data up to this point. So here the development between Mr. Sakshar and High-Tech Limited. Okay, and one of the important, Sakshar handed over the land for development activities to High-Tech Limited. In return, High-Tech Limited paid a consideration of cash 1 crore plus 3 flats in developed property. 3 flats. Total consideration 1 crore plus 3 flats. So next, the certificate of completion of society is issued by the authority on 10/8/2021. So 45 subsection 5A says that year of chargeability of capital gain is year of issue of completion certificate. So here the completion certificate issued on 21/22 year. Therefore, the transferor is required to calculate capital gain in 21/22 itself. On such date, stamp duty value of flat on society was 2 crores 51 lakhs. This is the stamp duty value of each flat on the date of issue of completion certificate. So now again come to 3 flats provided as consideration. The stamp duty value of each flat is equal to 2.51 crores. So here one of the important total consideration is equal to 3 flats into 2.51 crores is equal to 7 crores 53 lakhs plus cash consideration is equal to 1 crore. Total 8 crores 53 lakhs. This is the consideration. Have you understood? Next. Subsequently up to this point, this is the information relating to 45 subsection 5A. Next, subsequently is nothing but after receiving 3 flats by Mr. Sakshar, subsequently on 31/8/2021, out of 3 flats received as consideration, 2 flats of the society were sold for rupees 2 crores 70 lakhs each, while the stamp duty value of each flat on the date is 2 crores 98 lakhs. During the previous year 21-22, Mr. Kevin has earned a salary income of assessee is having. Assessee here the transfer is having Kevin. Transfer is nothing but 2 flats were sold to Kevin. Kevin is having salary income of 30 lakhs 50,000. So answer some MCQs based on the information up to this point. So MCQ 1, what would be the total, what would be the tax if any required to be deducted at source? Required to be deducted is nothing but TDS related point. Is there any TDS obligations? Made by High Tech Limited in respect of agreement entered into with Mr. Sakshar? So here 45 subsection there is a TDS provision called 194 IC. Please verify section 194 IC. So there was a TDS section. It says that under joint development agreement under section 45 subsection 5A, if developer has paid any consideration in cash to the person who handed over the land for development, then such payment is subject to TDS under section 194 IC at the rate of 10%. Okay, so here the developer paid a cash consideration of 1 crore rupees. This amount is subject to TDS under section 194 IC at the rate of 10%. So please verify the TDS chapter. So now this is the correct answer is here the cash consideration paid 1 crore. 1 crore into 10%, 10 lakhs. TDS under section 194 IC. $1 crore into 10%. Okay, this is one of the MCQ which is relates to TDS. Next, what would be the capital gain in the hands of Mr. Sakshar in respect of agreement entered into with High Tech Limited, and in which year it will be taxable? In which year it will be taxable? 45 subsection 5A says that year of issue of completion certificate. Capital gain shall be arise in the year of issue of completion certificate. But here is what would be the capital gain in the hands of Sakshar for handed over his land to developer for development activity. So capital gain should require to calculate the capital gain here. So here computation of capital gain is the format is consideration minus cost of acquisition. Okay, so consideration here is 3 flats received as consideration. It was already calculated here. Consideration is equal to 8 crore 53 lakhs. Consideration is equal to 8 crores 53 lakhs. 8 crores 53 lakhs. 8 crores 53 lakhs consideration. Minus cost of acquisition is, please refer the problem. Cost of acquisition here is 80 lakhs 50,000. The land was acquired by Sakshar in 2017 for 80 lakh 51,000 and acquired in 2017 and handed over for development to 2019. It's a less than 24 months. Therefore, it is a short-term capital asset. Indexation facility need not made any indexation here is. So consideration it was already calculated 8 crores 53 lakhs minus cost of acquisition 80 lakhs 50,000. The balance is the capital gain, short-term capital gain. This is the second question answer. Consideration, it was already calculated. Consideration is equal to 8 crores 53 lakhs minus cost of acquisition is equal to 80 lakhs 50,000. 7 crores 72 lakhs 50,000. 7 crores 72 lakhs 50,000. So 7 crores 72 lakhs 50,000. This is second question answer, sorry. This is relates to second question. 7 crores 72 lakhs 50,000. That's it. 7 crores 72 lakhs 50,000. Consideration is equal to 8 crores 53 lakhs minus cost of acquisition is equal to 80 lakhs 50,000. 7 crores 72 lakhs 50,000. It's a short term capital gain because the period of holding less than 24 months. Have you understood? Okay. Next, question number 3. This question belongs to after receiving 3 flats by the Sakshar, subsequently out of the 2 flats were sold to some other person. Please verify the problem. After receiving 3 flats, subsequently Mr. Sakshar sold 2 flats in society to Mr. Kevin for a consideration of rupees 2 crores 70 lakhs each. But the stamp duty value of each is equal to 2 crore 98 lakhs. Here 50C gets attracted automatically. So 50C says that if actual consideration is less than stamp duty value, then stamp duty value to be considered as consideration. So subsequently 2 flats were sold by Kevin Sakshar to Kevin at the rate of 2 crores 70 lakhs each. But the stamp duty value is 2 crores 98 lakhs. So 2 into 2 crores 98 lakhs to be considered as consideration. Minus the cost of acquisition here is, it was not acquired by the Sakshar, it was received from developer High Tech Limited as consideration for development activities. So here the cost of acquisition is whatever the stamp duty value has taken earlier for calculating the capital gain under section 45(5)(a), the same amount to be considered as cost of acquisition here. So that's the one of the important point. Therefore here consideration is equal to 2 flats into 2 crores 98 lakhs and the cost of acquisition is equal to earlier the flats was received by issue of completion certificate at that time the stamp duty value is 2 crores 51 lakhs. This 2 crores 51 lakhs is the cost of acquisition, 2 crores 98 lakhs is the consideration. Okay, that's the question number 3. Cost of acquisition is equal, consideration is equal to 2 into 2.98 crores. Here section 50C gets attracted, is equal to 5 crores 96 lakhs minus cost of acquisition is equal to 2 into 2.51 crores. This is the stamp duty value as on the date of issue of completion certificate, which was taken earlier for calculating the capital, the above mentioned capital gain. So is equal to 5 crores 2 lakhs. The resultant capital gain is 94 lakhs. This is also a short term capital gain because the 2 flats were sold immediately. Here also the period of holding less than 24 months. Therefore, the resultant amount is short term capital gain. So answer is D. Next, what would be the total income of Mr. Kevin? Mr. Kevin is a third party. Sakshar is the first party. So High Tech Limited is the second party. Third party, Kevin. Kevin is nothing but 2 flats sold to Kevin. So Kevin is a buyer of 2 flats. What was the total income of the Mr. Kevin? What was the total income of Kevin? So here one of the important point, Kevin point of view, when the transferor is required to calculate capital gain. But Kevin is the transferee point of view. If any benefit arises in the hands of buyer, it will be taxable as a gift under the head income from other sources. Have you understood? So here Kevin point of view, the stamp duty value of asset is 2 crores 98 lakhs, but it was acquired only for 2 crores 70 lakhs. Purchase of buildings, purchase of flats for inadequate consideration by the Kevin. Therefore, whatever the benefits received by the Kevin will be taxable as gift under the head income from other sources. What was the benefit on each flat? In each flat, there was a benefit of 2 crores 98 lakhs minus 2 crores 70 lakhs, 28 lakhs. 28 lakhs into 2 flats, that is 56 lakhs. So, have you understood? 56 lakhs is the gift received by Kevin. Gift 50 lakhs. It was taxable under the head other sources. Gift is equal to 2 flats into 2.98 crores minus 2.7 crores is equal to 56 lakhs. Plus, in addition that, Kevin is having salary income also. Salary income is given in the problem. Kevin is having salary income of rupees 30 lakhs 50,000. 30 lakhs 50,000. Total income of Kevin, salary income of Kevin is equal to 30 lakhs 50,000. Total income is 86 lakhs. 30 lakhs 50,000 minus standard deduction 50,000. So, the Kevin is entitled to claim standard deduction. 30 lakhs 50,000 minus 50,000. 30 lakhs. Therefore, total income is 86 lakhs. Okay. So, first 2 questions, first 3 questions, Sakshar point of view, and the 4th question is Kevin point of view. Calculate the total income. He has 2 incomes. One is gift. Second one is salary income. Okay. Next, last one. What would be the total deduction available under relevant provisions of the Income Tax Act 1961? Sakshar. So, in respect of interest on loan taken from SBI. So, it's a house property related, and Chapter 6A deduction is also available in this case. So, please read the last paragraph of the question. Out of the proceeds received on sale of land, Mr. Sakshar has purchased a house on 8/9/2021 for consideration of 30 lakhs. Mr. Sakshar has purchased a house for rupees 47 lakhs and occupied for own residence. It's a self-occupied property. Next, Mr. Sakshar has taken a loan, housing loan, 35 lakhs, 80% of the stamp duty value from SBI for purchase of house, which was sanctioned and disbursed at the rate of 12% per annum on 1/7/2021. Date of sanction of loan is differ from date of disbursement of loan. Interest shall be calculated only from disbursement of loan. So, please remember this point very carefully. So, here the disbursement date is 1/7/2021. So, he does not own any other residential house on the date of sanction of loan, Mr. Kevin. And based on this information, calculate the interest. Calculate the interest only from 1/7/2021 is nothing but 9 months. 9 months interest. So, here loan amount is 47 lakhs. 47 value of house 47, but loan one is 37 lakhs into 12% into 9 months. This is the calculation. 35 lakhs into 12% into 9/12. 3 lakhs 15,000. That's the answer. Just calculate the interest. 35 lakhs into 12% into 9/12. 3 lakhs 15,000. So, if you want to know what is the treatment of this 3,50,000, here the property was occupied by assessee for self-occupation. Therefore, out of this amount, you shall eligible to claim deduction under section 24B, 2 lakhs. 2 lakhs is eligible as deduction under section 24B from under the head income from house property. And the balance interest 3,15,000, out of 3,15,000, the balance interest will be allowed as deduction under section 80EA. 3.15 lakhs. That's it. 1.15, sorry, 1.1. 2 lakhs plus 1.15 lakhs. This is the treatment. So this is first one is a case scenario. Based on that, answer 5 MCQs. I think all MCQs are very easy. You know, have you understood? Yeah. Next, MCQ number 6. It's a chapter 6A related MCQ. Chapter 6A. Chapter 6A deductions. Mr. Raj, age 65 years, is a salaried person. He has taken life insurance policy on his major son name on 1/11/2014. The sum issued of LIC policy is 16 lakhs and the premium paid is 1,70,000. So it's an ATC deduction. He has also taken a medical policy 10 lakhs for self and his wife on 1/11/2021. The medical policy is valid for 5 years. He has paid one-time premium of 1,80,000. This is one of the important concept in ATD. Single premium policies. He has paid one-time premium of 1,80,000, but the validity of the policy is 5 years. Life of the policy is 5 years. How it will be claimed as deduction under section 80D. So ATC is very simple. LIC policy has taken, the policy sum issued is 16 lakhs. Premium paid 1,70,000. Date of policy 1/11/2014. So ATC says that if policy was taken on or after 1/4/2014, then deduction cannot exceed 10% of the sum issued. If assessee is a disabled person, then up to 15% can be claimed as deduction. So, but here there is no information about Mr. Raj is suffering with any disability. So therefore, ATC deduction is restricted to 10% of sum issued. So ATC is equal to sum issued 16 lakhs. 16 lakhs into 10%. Restricted to 1.6 lakhs. But ATC itself cannot exceed 1,50,000. Maximum deduction under section ATC cannot exceed 100. Therefore, the revised deduction is 1,50,000. Yeah, ATC, that's clear. And one more important here, 80D is very important. So here the premium was paid. Here the premium was paid. So premium was paid. It's a one-time premium. 65 years. It's a one-time premium and life of the 5 years. 80D says that if lump sum premium paid for more than 1 year, then such premium can be claimed as deduction on a proportionate basis during the life of such policy. Here life of the policy is 5 years. But here one of the important, so life shall be calculated based on the date of policy, date of end of the policy, when such policy will be closed, and identify the years in which those two dates was covered. That's one of the important point. So here one of the important policy is, here the one of the important point is, here the date of policy 10 lakhs for self and wife on one date of policy 1/11/2021 for 5 years. So 1/11/2021 date of policy. Date of policy is 1/11/2021. Exact the life of the policy is 5 years. End of the policy. Life is 5 years. On which date the policy will be closed? That's one of the important point. So please calculate 5 years from the date of policy. What was the last date? From 1/11/2021 to the ending date is 31/10/2022. Sorry, 5 years. 21, 22, 23, 24, 25, 26. This is the last date after 5 years, the expiry of the policy. Expiry of the policy. And one more important, now identify the years in which those two dates were covered. So here the date of policy was covered in the year 21, 22. Ending date was covered in the year 26, 27. Now calculate the number of years between these 2 years. Number of years involved: 21, 22, 22, 23, 23, 24, 24, 25, 25, 26, 26, 27. Therefore, 6 years involved between these 2 years. Now, the lump sum premium can be claimed by the assessee over a period of 6 years. Don't consider the life given in the problem. So, here the deduction 80D is equal to 1.8 lakhs divided by 6, 30,000. 30,000 in each year. Generally, 50D is applicable, sorry, 80D is available only to up to 25,000. If assessee is a senior citizen, then he can claim up to 50,000. So here entire 30,000 can be claimed by the assessee because assessee is a senior citizen. So here the total deduction is equal to 1,50,000 ATC, 1,30,000 ATD. ATD 30,000. Total deduction 1,80,000. Have you understood? ATD, most important point covered in this. As I was said at the beginning, some of the points in this RTP is very unique. So don't neglect the questions covered in RTP, but each and every student must prepare the RTP for November 2022. Have you understood? 80D section is very important in this case. So it's a lump sum premium paid for more than 1 year. Then how it will be amortized, how it will be claimed. Good morning, students. So let's start the question number 9. So it's nothing but practical problems. The remaining MCQs 6, 7 and 8 will be discussed later. Just wait. Okay. 7 and 8 MCQs will be discussed at the end. So now we'll start the discussion with question number 9. It's a practical problem. Okay. From 9 onwards, all the problems is a practical nature. So question number 9, it's a residential status related problem. Residential status. So Mr. Dhanush, as an Indian citizen, age 35 years, worked ABC Limited in Mumbai. He got job offer from XYZ Limited Incorporation USA on 1/6/2020. He left India for the purpose of a job on 1/6/2020, that is in 2021. So in 2021, the assessee is left from India for the purpose of employment. Actually, for individual residential status, there are 2 exceptions. Exception number 1, Indian citizen left India for the purpose of employment. So here the assessee left India during the previous year 2021 itself. But now we are solving this problem in 21-22. Therefore, so in earlier preceding previous year, he left India for the purpose of employment on 1/6/2020. So next, he left India for the first time on 31/7/2020 and joined XYZ Limited Incorporation on 8/8/2020 during the previous year 21-22. This is the information which we are required while calculating the status in the previous year 21-22. So 21-22, Mr. Dhanush visited India on 25/5/2021 to 22/9/2021. He has received the following incomes for the previous year 21-22. So this is an exception to general rule. Generally, individual status is having 2 exceptions. One is Indian citizen left India for the purpose of employment, and exception number 2, Indian citizen already settled outside India visit India during the current previous year, or person of an Indian origin also. So here the assessee was covered in exception 2. Because during the current previous year 21, we are required to solve the problem in 21-22 itself. So in 21-22, he visit India. Because he left India in earlier preceding previous year 2021. So already settled outside India. During the current previous year 21-22, he visited to India. So therefore, here the assessee was covered in exception 2. Exception 2. Exception 2 for individual residential status says that exception 2, I give you a practical individuals are having two exceptions. Exceptions. Exception 1, Indian citizen, left India either for employment, A, for employment, including self-employment also, B, as a crew of an Indian ship. These are the cases covered in exception 1. In exception 1, here the treatment is apply B1 only. Apply B1 only. If satisfied, apply additional conditions also. If B1 was satisfied, apply A1 and A2 also for ascertaining his ordinary status. This is the treatment in exception 1. But here assessee not covered in exception 1 because he left India in preceding previous year, 2021. So in current previous year, what was the status? He is visited to India. Therefore, here the assessee was covered in second exception. Exception 2, Indian citizen or person of an Indian origin comes to India on visit. Visit is nothing but temporary basis. So, but here one of the important point, here the assessee in problem number 9, the assessee was covered in exception 2. So, this exception again classified into two parts. Part A, exception 2, part A, his total income is total income other than income from foreign sources. Does not exceed 15 lakhs. Does not exceed 15 lakhs. So here exception 2 part A, in this case the treatment is same as in exception 1. The same treatment as it was applicable to exception 1 will be followed as it is here also. There is no change. But part B, this is one of the important part B against sentence B. His total income other than the income from foreign sources exceeds 15 lakhs. Exceeds 15 lakhs. Here one of the important apply B1 or modified B2. So apply B1 or modified B2. B1 apply B1 or modified B2. So need to check both the conditions here. So that is one of the important point. Modified B2 is nothing but slightly change the basic condition to replace 120 days instead of 60 days in basic condition 2. That's the modified basic condition 2. So that is simply says that stay in India during the current previous year 120 days and stay in India during preceding 4 years aggregate at least 360 days. This is the modified B2. So if apply B1 or modified B2. But what about additional conditions? If B1 was satisfied, apply A1 and A2 also for ascertaining his residential status. If B1 was satisfied, then need to check additional conditions also for ascertaining his ordinary status. But one more important, if modified B2 was satisfied, then need not check additional conditions. Then he shall be treated as resident but not ordinarily resident always. That's the important point. If modified B2 was satisfied, then don't check the additional conditions because additional conditions not applicable in that case. So then the assessee shall be directly decided as resident but not ordinarily resident. That's the concept in exception 2. So have you understood the provision of individual status? But coming to the problem. So here during the current previous year, he visited India He was covered in exception 2. But now the question is exception to part A, part B. Whether he was covered in part A or part B. So will be decided based on his total income. So here given the details of the total income. So once we'll check whether the total income exceeds 15 lakhs or not. So salary from XYZ Incorporation USA received in USA is a foreign source of income, therefore not considered. We should consider only the Indian source of income if it exceeds 15 lakhs or not. So this is foreign source, not considered. Next, dividends from Indian company, yes, it shall be treated as an Indian source to be considered. Next, agricultural income from land in Punjab, it's an exempted income, exempt. Agricultural income from land in Punjab, it's an exempted income. Next, rent received from house property in Lucknow, yes, it shall be treated as an agricultural income. Sorry, house property income, it's an Indian source of income, yes, to be considered. Profit from business in USA which was set up in India, yes, set up in India, therefore it shall also be treated as Indian source of income. Yes, out of these incomes, dividends from Indian company, Indian source of income, 5,50,000 to be considered. So next one, agricultural income, it's an exempted income, ignore it. Just rent received, rent, there was a provision in house properties, rent not taxable fully. Out of rent, standard deduction is available only 30%. Balance 70% is only taxable. So out of the taxable portion is 70%. 70% is nothing but 2,80,000. 30% is the standard deduction available under the head house property. Next, PGBP income, because the profession was set up in India, therefore it shall be treated as Indian source of income, 6 lakhs. So total income, 5,50,000 plus 2,80,000 plus 6 lakhs. $5,50,000 plus 2,80,000 plus 6 lakhs. 14,30,000. Yes, 14,30,000. Yes, total income from Indian sources does not exceed 15 lakhs. He was covered in part A of exception 2. Exception to part A. Right. We should require to solve this question based on part A of exception 2. Part A of exception 2 says that what will be the treatment in this case? Same as in exception 1. Need to check basic condition 1 only. If not satisfied, then he shall be treated as a non-resident. Have you understood? So this is part A of exception 2 was covered in this problem. So please verify whether the number of days stay in India. He visited to India on 25/5/2021 and left India 22/9/2021. So stay in India between these 2 dates during the current previous year. Stay in India is equal to 25 May. Total May number of days 31. Out of that 24 days shall be excluded from 25 onwards. 31 minus 24, 7 days. May 7 days. June 30 days. July 31 days. August 31 days. September 22 days. Total number of stay in India 121 days. 121 days. But here exception 1 part B says that apply B1 only. Apply B1 only. B1 is nothing but 182 days stay in India at least. Then only he shall be treated as resident in India. So, but here actual stay is only 121 days. Therefore, he shall be treated as a non-resident. So, here the status of the assessee. So, status of the assessee is a non-resident. Based on the non-resident status, calculate the total income of the assessee. Out of these incomes, which income is taxable in the hands of non-resident? First point, foreign source of income, earnings outside India, receipt outside India, not taxable in the hands of non-resident. Dividends from Indian company, taxable in the hands of non-resident. Agricultural income from land in Pakistan, Punjab, exempted income, not taxable. Next, rent received from house property in Lucknow, taxable at the rate of 70%. Next, it's taxable in only resident and ordinary, resident but not ordinary. This will not be taxable in non-resident, not taxable. Therefore, here the taxable portion is only second case and fourth case. This one is taxable and rent is also taxable. Only two incomes will be taxable in the hands of non-resident. So first calculate the residential status of the assessee. Based on that status, calculate the total income of the assessee. Determine the residential status and compute his total income. First, the status of the assessee is non-resident. And based on that non-resident status, calculate the total income. That's the question number 9. Have you understood? So please verify the answer. So this is only two incomes will be taxable, because assessee status is a non-resident in India. This is the Indian source of income. This will be useful for calculating his residential status, whether he was covered in exception 1 or exception 2. But this is not a taxable income. First, calculate the residential status based on this information. After that, calculate the total income. This is the total income statement. Okay. Question number 10. Question number 10. Mr. Roy was a house in Kolkata. He said income from house property. Income from house property. Mr. Roy was a house in Kolkata during the previous year 21-22. 3/4 portion of the house self-occupied. 3/4 portion of the house self-occupied and 1/4 portion let out for residential purpose at a rent of 12,000 per month. The tenant vacated the property on 28 February 2022. The property was vacant in March 2022. Rent for month of January and February could not be realized. It is nothing but unrealized rent. Here the property 1 month vacancy, 2 months unrealized rent. So on its efforts, all the conditions prescribed under Rule 4 are satisfied. Municipal value of the property is 4,50,000, paid rent 4,70,000, standard rent 5 lakhs, and municipal taxes 10% of the municipal value. Loan interest, a loan of 30 lakhs was taken by him during the previous year, and interest on loan on the previous year 21-22 was 1,51,000. Interest given directly in the problem, need not calculate. So that's the based on this information, calculate the income from house property of the assessee. I think this is too fundamental problem. There is nothing new in this problem. There are so many of similar problems in your material. So nothing new in this problem. So it's a fundamental problem. But the status involved in this problem is part of the property let out, part of the property self-occupied. 3/4 portion of the self-occupied, 1/4 portion let out. That based on that status, you should require to calculate the income. So I give you some details. The property is having two units, 3/4 portion, 1/4 portion. 3/4 portion self-occupied, 1/4 portion let out. Okay, self-occupied calculation is very easy. NAV shall be taken as nil. Minus only one deduction is available, that is interest under section 24B. Interest deduction is only available to self-occupied property under section 24B. That to here the interest given in the problem. So interest 1,50,000. The 1,50,000 is for entire property. So need to apportion this amount between let out and self-occupied. Out of that 3/4 and 1/4. 3/4 portion of the interest to be claimed as deduction to self-occupied portion. 1/4 to be claimed as deduction to let out portion. So that's the information. And for let out property, you should require to fill the entire format. Need to calculate GAV and less deduct municipal taxes then we'll get NAV and deduct standard deduction and interest. After that, we'll get the income from house property in let out portion. This is the computation procedure. Have you understood? 3/4 portion, 1/4 portion. But here the data given on consolidated basis, the entire data is given on consolidated basis. Therefore, each and every amount shall be apportioned between let out and self-occupied separately. Have you understood? It's a purely fundamental problem. Purely fundamental problem. 3/4 is self-occupied, 1/4 let out portion. 3/4 resultant income negative because NAV shall be taken as nil minus only one deduction is available, that is interest. But whereas in let out portion, I give you the details, the GAV calculation for let out portion. Some students are having some doubts about GAV calculation. So GAV municipal value 4,50,000, paid rental value, solve the problem, 1,50,000 into 3/4. 1,12,500. 1,12,500. 3/4. Therefore, income from self-occupied portion 1,12,500 negative. But while calculating the 1/4 portion, need to calculate GAV. GAV is equal to. So need to apply 3 steps. So some students are having some separate different calculations for GAV. So I give you one standard calculation. If you comfortable for this calculation, you need to follow this. Okay. So GAV step 1, municipal value or paid rental value, whichever is higher to be considered. But here the municipal value is equal to 4,50,000. 4,50,000 into 3/4 portion. Sorry, 1/4 portion. We are required to calculate let out portion 1/4. So 4,50,000 into 1/4. 1,12,500. 1,12,500. And the next, paid rental value. Paid rental value 4,70,000 into 1/4 portion. 1,17,500. So whichever is higher, 1,17,500. So step 2, amount as per step 1 or standard rent, whichever is lower. Amount as per step 1 is 1,17,500. But what about standard rent? So here standard rent is 5 lakhs. 5 lakhs into 1/4 portion. 1,25,000. Whichever is lower, 1,17,500. This is the expected rent. So step 3, expected rent is equal to 1,17,000. Actual rent minus unrealized rent. Actual rent minus unrealized rent. Actual rent, here the property was 1/4 portion was let out for 12,000 per month. 12,000 per month, out of that 1 month vacancy in this problem. Therefore, the actual rent realized only for 11 months. 11 months minus out of that 2 months rent has not realized. So therefore, the net amount realized is only 9 months. So actual rent 11 months into 12,000 minus out of that 2 months rent not realized, 2 into 12,000. Actual rent minus unrealized rent. So therefore, net amount realized is 1,08,000. So 1,08,000. Here, whichever is higher or whichever is lower to be considered. Here, section 23, subsection 1, class C says that if actual rent is less than expected rent due to vacancy, only because of vacancy, then whichever is lower to be considered. Yes, here the same consequence has applied. So one of the important, actual rent realized 1,08,000. If here 1 month vacancy, the property was vacant for 1 month. If there is no vacancy, amount would be realized is another 12,000. So if there is no vacancy, if there is no vacancy, actual rent would be 1,08,000 plus one more month 12,000, 1,20,000. Due to vacancy, actual rent was realized only 1,08,000. So that is one of the important point. If property had not vacant for such 1 month, then the rent would be realized is 1,20,000. That is more than the expected rent. But whenever the property was vacant for 1 month, then automatically the actual rent shortfall with compared with the expected rent. So that is one of the important. Blindly I give you an application. There are two equations to be considered. So here condition, if actual rent is less than expected rent due to vacancy, then whichever is lower to be considered for step 3. Okay. So here actual rent is less than expected rent only because of vacancy, therefore whichever is lower to be considered 1,08,000. So that's one of the important calculation. Some of the students are having something different method to calculate the GAV. So please follow the method which you learned at the time of preparation. Okay, don't change the method suddenly. Okay, important. So last step, first step always whichever is higher to be considered, second step always whichever is lower to be considered, but whereas in step 3 either higher or lower subject to some conditions. Please verify whether higher or lower. For example, section 23 subsection 1 class C, if such section gets attracted, then whichever is lower to be considered, otherwise whichever is higher. For applicability of such section, conditions are one of the important. The property must be fully let out property and it must be vacant during the previous year, either part of the year or full year. The third condition is due to vacancy, actual rent is less than expected rent. If all these three conditions were satisfied, then whichever is lower to be considered. Here all these three conditions were satisfied in this problem. Therefore, whichever is lower to be considered. Have you understood? So that's the one of the important point. Therefore, GAV is equal to 1,08,000. The remaining problem is as usual, 1,08,000. Municipal taxes 1/4 portion to be considered. Automatically NAV will arise. Thereafter, standard deduction 30% of NAV, interest 1,51,000 into 1/4 portion. Please verify the answer once. Problem number 10. So this is self-occupied portion. Answer 1,13,000. So 3/4 of the 1,50,000, 1,13,250. I has taken wrongly calculation mistake. 1,13,000. Sorry, 1,51,000 into 3/4. Yes, 1,13,250. 1,13,250. This is the answer for self-occupied portion. So for let out portion, need to fill the total statement. Self-occupied portion 1/4. Let out portion 1/4. Self-occupied portion 3/4. Let out portion GAV calculation. GAV is equal to 1,08,000. Municipal taxes given in the problem 4,50,000 into 1/4, 11,250. Net annual value, standard deduction. Interest 1/4 portion, 37,750. This is. Have you understood? I think it's a purely fundamental problem. But here the confusion is for step 3, whichever is lower or whichever is higher is something important concept. Okay. Next problem number Ramesh. Sorry, that is most important problem I think in this RTP. This is one of the complicated and important capital gain related problem. Capital gain related problem. That too section 50C gets attracted in this problem. 50C. So Ramesh, a property dealer. Has developed an independent floor of 4 residential units. He sold So he constructed a developed an independent property. So in such property having 4 residential units, he sold one of the residential unit to Mr. Vikas. Transferor is Ramesh, buyer is Mr. Vikas. So who is a dealer in automobile, dealer in spare parts for rupees 55 lakhs. It's an actual consideration. The agreement was, however, on 1/4/2021. Mr. Ramesh had received a down payment of 5 lakhs, an account pay check from Vikas on the date of agreement. Mr. Ramesh sold. So this is the information of transaction between Ramesh and Mr. Vikas. So total 4 residential units constructed by Ramesh. 1 unit was transferred to Mr. Vikas for 55 lakhs. But stamp duty value, the agreement was entered on 1/4/2021. Mr. Ramesh had received down payment 5 lakhs by check on the date of agreement. And the remaining 3 units sold to Mr. Raj and Mr. Ashok and Mr. Ashish. Okay, total 4 units for rupees 60 lakhs. So on each date of transfer is nothing but date of registration on 1/12/2021. All the units were transferred by way of first time allotment. This is one of the important word. Something students are not having about this concept. I give you a most important information. So the stamp duty value on different dates. 1/4/2021 is nothing but agreement date. Agreement between Ramesh and Vikas. Second one, 1/6/2000, registration date between Ramesh and Vikas. The third one, registration date between Ramesh and other parties. So there are 4 dates involved in this problem. So based on that information, calculate the capital gain consequences, and buyer point of view need to calculate the tax consequences in the hands of buyer. Buyer point of view, there may be a possibility of gift, purchase of property for inadequate consideration. So I think this is the most important problem in this RTP. So I think 2 or 3 important problems are there. Out of that, this is one of the important problem. Okay. So give you the information in brief. The transaction between Ramesh and 4 parties, Vikas, Raj, Ashok, Ashish. Ramesh, Vikas, Raj, Ashok, Ashish. So first 1 unit was transferred to Vikas, transferred for 55 lakhs. So for all 3 units transferred to remaining 3 persons for 60 lakhs. So this is the actual consideration. So that is one of the important point. And one of the important point, another information in this problem is stamp duty value. That there are 3 stamp duty values as given in the problem, but which value to be considered as consideration as per section 50C. 50C is one of the important. So here the date of agreement between Ramesh and Vikas given in the problem 1/4/2021. 1/4/2021. 1/6/2021 is the registration. 1/4/2021. Agreement 1/4/2021. 1/4/2021. At that time the stamp duty value at the time of agreement is given in the problem 65 lakhs. At the time of registration 1/6/2021. Agreement 1/4/2021. Stamp duty value at that time is 65 lakhs. Registration 1/6/2021. Stamp duty value at that time is 1/6/2000, 68 lakhs. But here is only registration. There is no agreement date between other parties. Only registration date. That is because for all other parties the property was sold on 1/12/2021, there is no agreement. Only one stamp duty value is available. That is 1/12/2021, 70 lakhs. For all other parties, the stamp duty value is only 70 lakhs. That's the important information. Registration. Stamp duty value 70 lakhs. Registration. Stamp duty value 70 lakhs. Registration. Stamp duty value 70 lakhs. So this is the information given in the problem. Based on this information, calculate the tax consequences in the hands of transferor as well as in the hands of transferee. Okay. So here the Ramesh is the property dealer. Property dealer. Therefore, section 43CA gets attracted. So instead of section 50C. So here one of the important point in this problem, in this problem, 43CA is involved in this problem. 43CA, because here the Ramesh is a property dealer. For property dealer, the units sold to other persons will be treated as stock in trade. Therefore, instead of 50CA, you should require to follow section 43CA. Of course, in both the sections, the provision is same. What will be the provision involved in both the sections? If actual consideration is less than stamp duty value, then stamp duty value to be considered. I give you the provision, 43CA provision. 43CA says that if actual consideration is less than stamp duty value, then consideration is equal to stamp duty value to be considered. Stamp duty value to be considered. Stamp duty value to be considered. So 43CA. So here the Ramesh is required to follow 43CA instead of 50C. If Ramesh is not a property dealer, then these assets shall be treated as a capital assets in the hands of Ramesh. In such case, you need to follow section 50C. So 50C is applicable to capital asset, 43CA is applicable to stock in trade. Here Ramesh is the property dealer. He is required to calculate PGBP income. Therefore, he need to follow section 43CA. But of course, the provision is same. The provision in 43CA and 50C is same. Okay. So provision is, if actual consideration is less than stamp duty value, then consideration is equal to stamp duty value. But here is one of the important point. If exceeds 110% of actual consideration. 110% of actual consideration, stamp duty value to be considered only if it exceeds 110% of actual consideration. So in some cases, 120% to be considered instead of 110%. This is the most important point. In some cases, stamp duty value to be considered only if it exceeds 120% of actual consideration. First to the transaction between Ramesh and Vikas. First of all, we should require to calculate Ramesh and Vikas, the transaction between Ramesh and Vikas. Here there are two stamp duty values available. Here Act says that if as on the date of agreement, as on the date of registration, the stamp duty value are not the same, then subject to some conditions, stamp duty value on the date of agreement to be considered. The conditions are, the seller is required to receive consideration from the buyer. The date of receipt on or before the date of agreement. Mode of receipt, account pay check, account pay bank draft, electronic clearing system. If three conditions were satisfied, then agreement related stamp duty value to be considered. If these three conditions were not satisfied, then registration related stamp duty value to be considered. But please verify the problem whether the conditions were satisfied. Yes, here the conditions were satisfied. Here the conditions were satisfied. Please verify the first paragraph ending 2 lines. The agreement was however entered on 1/4/2021. Mr. Ramesh had received a down payment of 5 lakhs, has received the consideration either full or part. It is sufficient to receive the part of the payment also. On account pay check as condition was satisfied, and on the date of agreement as condition was satisfied. Whenever these three conditions were satisfied, then stamp duty value on the date of agreement to be considered, registration stamp duty value shall be ignored. So now coming to the provision, 43 CA says that if consideration is actual consideration is less than stamp duty value, then consideration is equal to stamp duty value to be considered only if it exceeds 110%, 120% of actual consideration. Here 120%, generally 110%, but in exceptional case 120% to be considered. But what are the exceptional case? On satisfaction of some conditions. I'll show you the conditions. Just verify the problem. This is the most important and the new point. I think 90% of the students are not aware about this point. Please prepare this problem mandatorily. Maybe I expect this problem in upcoming examination. Conditions. I show you the conditions. Yes. Conditions. So here one of the important, generally 110% to be considered, but in exceptional case 120%. In case transfer of residential unit for the first time allotment, condition 1. This is that is a first time allotment. This is one of the condition. And transfer date 12/11/2021. 12/11/2021. Second condition. Consideration does not exceed 2 crores. If these three conditions were satisfied, then instead of 110%, 120% to be considered. So that's the one of the important. Please be prepared. This point very important in examination. So condition number 1, that was the first time allotment, and the allotment between 12/11/2020, 30th/6/2021, and the consideration does not exceed 2 crores. Yes, here in the Ramesh point of view, all these three conditions were satisfied. Here Ramesh was satisfied all these three conditions. Here the allotment date June. All those conditions were satisfied by the Ramesh. So therefore here need to consider 120% instead of 110%. Yes. Here the date of allotment of the property is Ramesh property 1/6/2021. Yes, condition was satisfied. Consideration just only 55 lakhs, less than 2 crores, satisfied. This is the first time allotment. First time allotment. Yes, this one also satisfied. So therefore, whenever these three conditions were satisfied, then 120% to be considered. So directly come to the point. So 43 CA says that if actual consideration less than stamp duty value, then stamp duty value to be considered if it exceeds 120% of actual consideration. 120% to be considered. 120%. So because all the conditions were satisfied. Now check whether the stamp duty value exceed 120% or not. Here the actual consideration is 55 lakhs. Stamp duty value on the date of agreement to be considered, 65 lakhs to be considered. Stamp duty value is 65 lakhs. 120% of actual consideration. Actual consideration 55 lakhs into 120%. 66 lakhs. Yes, 66 lakhs. Yeah. Stamp duty value to be considered only if it exceeds 120% of actual consideration. But here stamp duty value not exceeding 120% of 120% of actual consideration. Here stamp duty value not exceeding 120% of actual consideration. Therefore, consideration is equal to actual consideration to be considered, that is 55 lakhs. So that's the point. So Ramesh point of view need to calculate PGBP income because he is the property dealer by taking the consideration 55 lakhs. Actual consideration. Ignore the stamp duty values. So have you understood? So the important point. Okay. So next, what about for remaining three parties? Remaining three parties, only one stamp duty value is available. That amount to be considered as it is, because only one stamp duty value. And compare one of the important for all other persons, the date of allotment is a December month. That is one of the condition was satisfied. One of the condition was not satisfied. Therefore, while considering 120%, There are three conditions. Condition number one, it's a first time allotment. Condition number two, date of allotment 12/11/2020 to 30th/6/2021. Consideration does not exceed 2 crores. Please check the remaining 3 units sold to all other persons. Remaining 3 units sold to all other persons. So remaining 3 units sold to 1/12/2021. That's the date of last date is 30th/6. Therefore, one of the condition was not satisfied. Therefore, here 120% to be considered. Here 110% to be considered. Ignore 120%. 120% to be considered only where the satisfaction of the three conditions. It must be a first time allotment, and it must be consideration does not exceed 2 crores, and the date of allotment between the dates specified there. But here the date condition was not satisfied. Therefore, 110% to be considered. Okay. So I give you explanation for all three parties. For all other parties, actual consideration is 60 lakhs each. Consideration stamp duty value is 170 lakhs. Please verify whether it exceeds for all other parties. Actual consideration 60 lakhs. Stamp duty value 70 lakhs. 110% of actual consideration is equal to 66 lakhs. Therefore, stamp duty value exceeds 110% of stamp duty value exceeds 110% of actual consideration. Therefore, here stamp duty value to be considered while calculating the PGBP income in the hands of Ramesh. Anyway, in the hands of transaction between Ramesh and Vikas, actual consideration to be considered. Ignore the stamp duty value because stamp duty value does not exceed 120%. But for all other parties, stamp duty values to be considered. Ignore the actual consideration because stamp duty value exceeds 110% of the actual consideration. So that's why this problem is very important. So here two parties. Party one, Ramesh point of view, need to calculate PGBP income because he is the property dealer by applying section 43 CA. Generally, stamp duty value to be considered only if it exceeds 110%, but subject to three conditions, 120% to be considered instead of 110%. So the transaction between Ramesh and Vikas, 120% shall be applicable because all those conditions were satisfied. For in all other cases, 110% to be considered because the condition was not satisfied. Have you understood? This is the treatment of Ramesh required to calculate PGBP income by applying 43 CA. But what about the treatment of buyer? Buyer point of view, the difference between purchase value and stamp duty value to be considered as gift. Gift calculation to be made in the hands of buyer. So buyer point of view, here the seller point of view, PGBP. Because he is the property dealer by applying 43 CA. The buyer point of view, income from other sources by applying gift provisions. Gift provisions. So gift is nothing but here purchase of property. The category of gift is equal to immovable property inadequate consideration. Immovable property inadequate consideration. Immovable property inadequate consideration. Here the taxable value is stamp duty value of such property minus consideration. Difference between stamp duty value and consideration. Taxable only the difference if exceeds, taxable only if it exceeds 50,000 or 10% of actual consideration, whichever is higher. That will be the gift provision, immovable property inadequate consideration. So in all four parties, buyer point of view need to calculate gift calculation. Have you understood? Please verify the problem. So taxable consequence in the hands of Vikas is nothing but income from others. Buyer, Vikas is the buyer, therefore income from other sources, gift concept gets attracted. So this is the gift, 56 subsection to class 10. Please verify thoroughly the matter. So I think this is you can't write lengthy presentation. So you can write only to the extent of availability of marks. So present only the matter is sufficient only for weightage of such problem. Okay. So this is entire provision was explained here, but based on this, in this information, you can select the information which is required to be present in examination if given. So this is gift 56 subsection to class 10. So Ramesh point of view, generally which category of gift gets attracted here is immovable property, inadequate consideration. Okay. So but taxable value is stamp duty value minus consideration. But if it exceeds 50,000 or 50,000 or 10% of actual consideration, 20% in case of Vikash, because the conditions were satisfied. So 20% in case of Vikas. For all other parties, 10% to be considered. Whatever the effect in 45 CA, so 43 CA, the same effect is also to be considered in gift concept. So next, Mr. Ashish, here only consider 10%. For all other parties, 10% to be considered. Okay. The presentation is too lengthy. It is not sufficient to present the entire information. Please verify the problem and whatever the points required. So please note down separately and prepare it as well. Compulsory, I think it may useful in upcoming examination. So tax consequences in both the parties. Transferor point of view PGBP, transferee point of view gift. PGBP, why PGBP will arise in the hands of transferor? Because the transferor is the property dealer. If he is not a property dealer, transferor point of view capital gain, transferee point of view other sources gift. Transferee has no effect. In earlier class, we have discussed the most important problem in this RTP is a capital gain related problem. So now I want to spend some time for discussion of the same problem, because some students are having some confusions in that area. Because the question is calculate the tax consequences in the hands of both the transferor as well as transferee. So transferor is a real estate person, therefore transferor is liable to taxable under the head PGBP. Transferee point of view, it will be taxable under the head other sources. So I give you a simple clarification. So for question number 11, there are 4 parties. Assessee is a Ramesh. Ramesh transferred the properties to 4 parties. The first party transaction is different from other party transaction. For other 3 parties, transactions are same date, same values. So the first party is something different. Okay. So I will give you the finishing of problem number 11. Okay. So problem number 11, first of all, Ramesh point of view. First party transaction between Ramesh and Vikas. Right. Ramesh and Vikas. Ramesh Vikas transaction. So Ramesh point of view, Vikas point of view. So Ramesh point of view, what is the treatment? Taxable under the head PGBP. First point, taxable under the head PGBP. Because he is a property dealer. Okay. So, and one more important point, which amount to be considered as consideration? Actual consideration 55 lakhs. Stamp duty value is 65 lakhs. But stamp duty value does not exceed 120% of actual consideration. Therefore, actual consideration to be considered. Don't consider the stamp duty value, just ignore the stamp duty value. Consideration is equal to actual consideration, that equal to 55 lakhs. And third point, ignore the stamp duty value because it does not exceed 120% of actual consideration. So this is the main points in Ramesh point of view while calculating the PGBP income, these points to be considered. So but Vikas point of view, it will be taxable under the head other sources. Taxable under the head other sources. Income from other sources. So, and one more important gift, taxable gift is equal to taxable gift. So the gifts are classified into 5 types. Out of that, the last category is immovable property inadequate consideration. Yes, here Vikas purchased the property for inadequate consideration because the stamp duty value of such asset is 65 lakhs, but it was acquired only for 55 lakhs. So it's an inadequate consideration. First of all, calculate the benefit. Benefit is equal to stamp duty value minus consideration. Stamp duty value 65 lakhs minus consideration 55 lakhs is equal to 10 lakhs. Now, one of the important point in this category, gift is taxable only if it exceeds. Taxable, gift taxable only if it exceeds, if the benefit exceeds 50,000 or 20% of actual consideration. That is, actual consideration 55 lakhs. 55 lakhs into 20%, 11 lakhs. So whichever is higher. So that is, whichever is higher is 11 lakhs. So here gift taxable only if the benefit exceeds 11 lakhs, but the actual benefit is 10 lakhs, not exceeding 11 lakhs. Therefore, taxable value of gift is equal to nil. Taxable gift is equal to nil. Nil. Reason, because it does not exceed the specified limit. Have you understood the transaction between Ramesh and Vikas? These are the main points to be considered while calculating the income in the hands of both the parties. Okay. So next we'll go to the other parties. So Ramesh, other parties. So here also Ramesh is calculate the PGBP income, taxable under PGBP. Other parties, for all 3 parties, same calculation is applicable because for all parties the consideration is same, stamp duty value is same. So the same calculation to be repeated for other parties, other 2 parties also. Okay. So taxable under the head PGBP and the consideration is equal to stamp duty value to be considered here, that is 70 lakhs. Because it exceeds 110% of actual consideration. Because it exceeds 110% of actual consideration. Actual consideration here is 60 lakhs. 110% is 66 lakhs. Stamp duty value 70 lakhs. Therefore, stamp duty value exceeds 110% of actual consideration. Therefore, stamp duty value to be considered. That's a very important point. Have you understood? So, in Vikas transaction, 120% to be considered. That's the new point which is very important in examination point of view. There are 3 conditions to be satisfied while considering 120%. It was already discussed in earlier class. Okay, please verify once again those 3 conditions. The consideration does not exceed 2 crores and it's a first time allotment and the transfer must be made between the specified dates. If those 3 transactions were satisfied, then 120% to be considered. But in all other cases, 110% to be continued. Okay. So Ramesh Vikas point of view, those 3 conditions were fulfilled. That's why 120% has considered. But in this case, 110% gets attracted because conditions not satisfied. Okay. So other sources, other parties point of view, taxable under the head other sources. Under income from other sources. Taxable value of gift is equal to here the benefit is stamp duty value minus consideration. benefit is equal to stamp duty value minus consideration. Stamp duty value 70 lakhs minus consideration 60 lakhs is equal to 10 lakhs. But now please check whether it is taxable or not. So in this case, gift is taxable only if it exceeds 50,000 or 10% of actual consideration. That is 60 lakhs is the actual consideration, that is 6 lakhs. Whichever is higher, that equal to 50,000 or 6 lakhs, whichever is higher, 6 lakhs. Here gift is taxable only if it exceeds 6 lakhs, but the benefit is 10 lakhs. Therefore, yes, here the taxable value of gift is equal to 10 lakhs. Yes, the benefit is taxable obviously because it exceeds the specified limit given below. So therefore, taxable value of gift is equal to 10 lakhs. This is the perfect explanation for problem number 11 in short form. Have you understood? So the new point in this problem is at the 120% concept is very important point in upcoming examination. Don't neglect. So be prepared this problem blindly. It's sufficient. Okay. So next we'll go to the next. So there are two MCQs which are pending. Two MCQs. The pending MCQs are I think 7 and 8. Yes, 7 and 8. This is also one of the important new point was involved in this MCQ. Therefore, don't neglect important MCQ. So, Mr. Karan completed his MBA. So, in April 2021 and joined in XYZ Limited on date of joining 1/5/2021. His basic salary 2,25,000 per month. He is paid 12% of basic salary as DA, forming part of retirement benefits. DA forming part is equal to 12%. He contributed 11% of pay and DA, 11% of basic salary and DA towards recognized provident fund. Recognized provident fund. And the accumulated interest to provident fund as on 31st March 2022 is 49,325. What will be the income chargeable to tax under the head salaries? Okay. So this is one of the important point here is so here computation of salary. There are 4 transactions involved in this problem. One is basic salary, DA, 11% employer contribution to RPF and interest accrued thereon. So calculate the salary income based on this information. Okay. So first of all, basic salary. Basic salary is equal to 11 months because he was appointed on May 1st. 11 months into, so here the per month salary is equal to 2,25,000. 2,25,000 is equal to 2,25,000 is 24,75,000. And next DA, 12% of basic plus DA. So 12% of basic salary is DA. DA, what was the DA transaction here? 12% of basic salary. So 24,75,000 into 12% is equal to 2,97,000. This is basic DA always taxable. Okay. So and employer contribution to RPF. Employer contribution to RPF is not taxable because it does not exceed 12%. There was a provision in PF. So employer contribution to RPF is taxable, exempt up to 12% of salary. So, but here the contribution is only 11%, not exceeding 12%. Therefore, nothing will be taxable in the hands of employee. That's it. It's a old provision. And the last one, interest accrued on employer contribution. This is the one of the important on employer contribution. This is the new point. Please concentrate on this point. It was an amendment in last year. The amendment says that if employed contributed to RPF in excess of 2,50,000. If contribution by the employer exceeds 2,50,000, then excess interest relating to excess contribution. The interest relating to excess contribution will be taxable as salary. That's the important point. Please concentrate on this point. It's very important in examination point of view. Okay. So let us calculate. The employer contribution is 11% of basic salary plus DA. Contribution 11% of basic plus DA. Basic plus DA into 11%. Contribution is equal to 11% of basic salary plus DA is equal to, we continue. So employed contribution is equal to 11% of basic plus DA, that is 3,04,920. So employee also contribute the same amount, that is 3,04,920. So total contribution employed plus employee, total contribution is equal to 6,09,840. 6,09,840. Employed contribution in excess of 2.5 lakhs is equal to 54,920. 54,920 is the excess contribution. Now we should require to taxable the interest, proportionate interest relating to such excess contribution. That's the important point. Okay. So now calculate. So now calculate the total contribution employed plus employee 6,09,000. Out of that interest accrued, total interest accrued is equal to 49,325. So out of total interest, the proportionate interest relating to excess contribution will be taxable. So okay. So therefore proportionate interest is equal to total interest 49,325 divided by total contribution 6,09,840 into excess contribution 54,920 is equal to, so 4,442 is the excess contribution, 4,442. Okay, that will be taxable under the head salary. So taxable excess contribution related interest. Therefore gross salary is equal to 27,76,442. Standard deduction 50,000. Therefore net salary is equal to 27,26,442. So that's the answer. So first one is the correct answer. Okay. Next question. Kajal, a general Mrs. Kajal, a general manager in Good Company Limited, was paid a salary of 4,50,000 per month. The above salary includes a non-monetary perquisite of 50,000 per month. As per the terms of employment, tax on non-monetary perquisites, that's the very important point in this problem. The tax on non-monetary perquisites borne by the employer instead of employee, and the PPF contribution made by the employee, it's eligible for deduction under section 80C. What will be the amount of tax deducted at source? TDS. Here the question is TDS under section 192. How much amount is to be deducted by the company from salary income? So, and here most important point is Mrs. Kajal, if she intimated to employer to opt presumptive provisions under section 115 BAC. Yes, 115 BAC calculation is involved in this problem. So here one of the important observation, when the assessee opted the 115 BAC, then the assessee lost some benefits, like standard deduction is not available and the 80C deduction is also not available, standard deduction not available. These benefits shall be ignored. So, and one more important point, how much amount is to be deducted by the employer? That's the question. First of all, we should require to calculate the tax liability, and out of total tax liability, the proportionate tax relating to non-monetary benefits shall be excluded because it was paid by employer on behalf of employee. So exclude. The balance tax is to be deducted by the employer. That's the answer. So I calculate the answer. Just wait. Salary income is equal to 4.5 lakhs into 12 is equal to 54 lakhs. First calculate the tax liability on 54 lakhs. Tax liability. Tax is equal to As per section 115 BSc, as per section 115 BSc, there are 7 slabs involved in 115 BSc. Up to 2.5 lakhs, nil, 0. Next 2.5 lakhs, 5%, 12,500. Next 2.5 lakhs, 10%, 25,000. Next 2,50,000, 15%, 37,500. Next 2,50,000, 20%, 50,000. Next 2,50,000, 25%, 62,500. Balance out of 54 lakhs, 15 lakhs exclude balance in the 39 lakhs, 30%, 11 lakhs 70,000. 11 lakhs 70,000. Therefore, total tax is equal to 13 lakhs 57,500. Plus here surcharge gets subtracted because total income exceeds 50 lakhs. 50 lakhs exceed. Therefore, assessee is liable to pay surcharge at the rate of 10%. 1,35,750. Tax plus surcharge 14 lakhs 93,250. Plus health and education cess 4%, 59,730. Total tax liability is equal to 15 lakhs 52,980. This is the tax liability on 54 lakhs. But now, out of total 54 lakhs, 6 lakhs related tax, that is non-monetary benefits, 50,000 per month into 12, 6 lakhs. 6 lakhs related tax was paid by employer. Therefore, that amount is not required to be deducted at source. So, that tax, the proportionate tax shall be excluded. Therefore, amount to be deducted is equal to 15 lakhs 52,950 into 400 divided by 450. In that 4.5 lakhs divided by 4 lakhs divided by 4.5 lakhs. So that is equal to 13 lakhs 80,427. This amount to be deducted as TDS by the employer under section 192. 13 lakhs 80,427. Chapter 6A not available, standard deduction not available because assessee opted 115 BSc. Have you understood? Next, go to next question, 12th question. It's a set off carry forward problem. It's a fundamental problem. So nothing new in this problem except first point, set off and carry forward. So I will explain just in lesser time. Nothing new in this problem. There are a lot of problems in your material like this. Okay. So set off carry forward. Income from T business. This is the only one point which is very important in this problem. It's a composite activity. Therefore, in composite activity, T business, only 40% will be treated as business, 60% agricultural. 40% business, 60% agricultural. So, 40% amount only to be considered while calculating the total income. Agricultural income exempt from tax. Next, loss from sugar business. It's a PGBP, non-speculative. Next, dividends from Indian company carrying agricultural operations as income from other sources. It is irrelevant whether the company is carrying any activity. The shareholders' dividend always be taxable under the head other sources. Next, agricultural income. It's an exempted income. Ignore it. Salary received as a partner from partnership firm. The same was allowed to firm. Whenever the expenditure was allowed to the firm, then it will be taxable to the partners automatically under the head PGBP. Next, net tangible value, income from house property. But NAV has given, but the income from house property is only 70%. 70% only. Only 70% amount to be considered because standard deduction available. So loss from gambling, ignore, invalid, not deductible from any area. Short-term capital gain on sale of land. It's a capital gain other than 111A. Other than 111A. Normal tax rate. So, it's a capital gain. It's a 112A loss. 112A loss. So, STT paid. That's important. Life insurance premium. It's an ATC deduction. Chapter 6 here. Bank interest, income from other sources. Income from other sources, but 80TTA deduction available. It's a savings bank account. 10,000 deduction under section 80TTA available. These are the incomes details during the current previous year. But in addition, that brought forward details has given in this problem. Brought forward details has given. So the first brought forward business loss. Yes, it can be adjusted in current year business income. Yes, in current year assessee is having business income. This is, that can be adjusted in this. Brought forward business loss can be adjusted against current year business income. No objection because business income available. Brought forward short-term capital gain. Yes, this can be adjusted in current year short-term capital gain. Yes, short-term capital gain available in current year. Yes. Next, brought forward loss from house property. Yes, it can be adjusted in current year house property loss. Yes, in current year assessee is having house property income. This is. Last one is a brought forward maintenance of loss relating to maintenance of race horses. It's a it shall be carry forward to subsequent year, because in current year assessee is not having similar activity, income from similar activity, because such loss can be set off against the same activity, similar activity. But during the current previous year assessee is not having such type of activity. Therefore, such loss can be carried forward to subsequent year. That's it. These are the details in this problem. Nothing new. It's a fundamental problem. Let's begin the discussion with question number 13, which is total income related problem. Total income. So total income. So profit and loss account has given, and some adjustments are there. So, and one more important point, please observe carefully the question. Compute the total income and tax liability of Mr. Kamal in a most beneficial manner. Most beneficial manner. Whenever this word was used by the examiner, compulsory we should require to apply the 115 BAC concept, optional scheme. So most beneficial manner is nothing but either normal method or optional method, whichever is beneficial to assessee. So required to solve this problem in both the methods. And one more important point. So in this problem, 35 AD business also involved. 35 AD business also involved in this problem. Warehousing. Therefore, 35 AD related business. Therefore, need to apply AMT concept also. So AMT concept and optional system. So I think this is a too lengthy problem. So please be prepared. This problem very important in examination point of view. So answer this problem, we should apply both the AMT concept as well as optional scheme concept under section 115 BSc. Okay. So let us start with adjustment number 1. Income tax refund includes amount 4,570 of interest allowable thereon. Interest allowed thereon. Income tax refund includes 4,000. Income tax refund not taxable, but interest on income tax refund will be taxable under the head other sources. So income tax refund includes amount of interest 4,570. Therefore, this will be taxable under the head income from other sources. Income tax refund. Income tax refund total 30,000 disallowed. It's not a business income. Out of that, interest portion will be taxable under the head income from other sources. 30,000 shall be disallowed from PGBP. Out of that, interest portion as given below will be taxable under the head income from other sources. Principal amount not taxable. Okay. So 4,570 is the interest portion. Remaining amount out of 30,000 is the principal portion. Principal not taxable, interest other sources. Next, bonus to staff includes amounting 7,500 relating to the previous year 2021. This amount belongs to preceding previous year 21-22. Now we are solving the problem in the previous year 21-22. But this amount relates to 2021.
paid in the month of December 2021. It's a application of section 43B. Most important adjustment. 43B says that if an expenditure relating to a particular previous year will be allowed in same previous year only if such payment was made within the due date for filing the return of income relating to such previous year. So here the expenditure relates to 21-22. So what was the due date for 21-22? Due date is equal to of return of income is equal to 31st July 2021. That was the last date for allowing the expenditure in 21-22 itself. So, but here the payment was made in December 2021, therefore not paid in the respective due date of the previous year 21-22. Therefore, it was not allowed as deduction in preceding year 2021. Therefore, it was whenever the expenditure was not allowed in respect to previous year, then it will be allowed in the year of actual payment. Here the payment was made in 21-22 itself. Therefore, it will be allowed as deduction in current previous year as new expenditure. Allowed as new expenditure. Allowed in 21-22. Reason? It was not allowed in 2021 because not made the payment within the due date for filing the return of income relating to the previous year 2021. Okay, 43B adjustment is very important. So next, advertisement expenditure includes an amount of 2,500 paid for advertisement published in a souvenir issued by political party. The payment is made by way of account paycheck. Advertisement expenditure. Advertisement expenditure. Adjustment number 3. Advertisement expenditure includes a souvenir published by political party. Act says that if any advertisement given in any pamphlets, souvenirs, invitations, brochures, calendars, etc. published by political party will not be allowed as business expenditure but be treated as a donations to political party, hence eligible under section 80 GGB or GGC, depends on donor. So here the donor, if donor is an Indian company, GGB, otherwise GGC. So anyway, this amount not allowed as business expenditure, but it will be treated as donation to political party, hence eligible under section 80. Here the assessee is an individual, therefore 80 GGC. Chapter 6 year deduction. 80 GGC, 2,500. But it was included in business expenditure, advertisement expenditure. Out of the 2,500 shall be disallowed. Next, bonus to staff. Second adjustment relates to bonus to staff. Yes, it was allowed in current previous year because it was not allowed in earlier previous year. It was already included in the above P&L account, therefore no adjustment. Next, income tax refund adjustment number 1. Income tax refund 30,000. Out of that, interest portion is only taxable under the head income from other sources, principal not taxable. 3 adjustments. Next, adjustment number 4. Miscellaneous expenses include miscellaneous expenses includes amount 15,000 paid towards penalty for non-fulfillment of delivery conditions, contract of sale of the region beyond control. It's allowed as deduction, no objection. Amount 1,000 paid to political party by check, political party donation to political party. Miscellaneous expenses includes amount of 1 lakh paid to political party by check. Yes, it's also eligible under section 80 GGC. Political party, but both the payments were included in miscellaneous expenditure. Out of that 15,000 allowed, 1 lakh disallowed. 1 lakh is not a business expenditure. 15,000 allowed. Even penalties generally, penalties relating to violation, infraction, infringement of any law will not be allowed as deduction. But this is not a violation. So this is paid towards penalty for non-fulfillment of delivery conditions. I think it's a delivered lately. For that he paid a penalty. It's not a violation of any act. Therefore, generally penalties of violation of law will not be allowed as deduction. Otherwise, for all other penalties will be allowed as deduction. No objection. So 15,000 will be allowed as deduction because it's not a violation of law. It's not a violation of any act. Any law. Therefore, allowed as deduction, no objection. But donation to political party eligible under section 80 GGC. Next, these two amounts was included in miscellaneous expenses. Out of that 1 lakh shall be disallowed. Donation to political party. Next, goods and service tax demand paid includes an amount of 5,300 charges as penalty for delayed filing of return of income. It's a violation of law. Therefore, disallow. 12,500 towards interest for delay in deposit tax. It will be allowed as deduction. Deposit deduction, late deposit. For that, he paid another amount of 12,750. So it's not a violation of law because Act itself contains the provisions for consequences on non-late payments. So compensation for late payment, it will be allowed as deduction, no objection. So goods and service tax demand paid includes, GST includes goods and service tax demand, adjustment number 5. It includes two amounts. One is violation of law related penalty and delayed payment of deposit related penalty. Out of that 5,300 only disallow. Balance will be allowed, no objection. Penalties points are very important in this problem. Next, Mr. Kamal had purchased a warehouse building of 20 lakhs in rural area for the purpose of storage of, it's a 35 AD business. 35 AD business, it will be treated separately. 35 AD related business. Mr. Kamal had purchased a warehouse building 20 lakhs. Purchased a warehouse building 20 lakhs. 100% deduction is available. So in rural area for the purpose of storage of agricultural produce, this was made available for use from 15/7/2021 and the income from this activity created in profit and loss account. Warehousing income was created in profit and loss account. Adjustment number 6. Disallow. It will be treated separately. Treated as separate business. Warehousing business revenue 22 lakhs 50,000. For that warehouse cost 20 lakhs. Out of that 100% deduction is available. So therefore 22 lakhs 50,000 revenue, 20 lakhs is the cost deduction under section 35 AD. Therefore 2 lakhs 50,000 is the business income under section 35 AD. That's the treatment. Next, depreciation under the Income Tax Act 65,000 only, but amount debited in P&L account 1,07,250. Balance shall be disallowed. 65,000 is the depreciation as per Income Tax Act. 42,000, 35, 42,250 shall be disallowed. Next, interest on loan includes an amount 80,000 paid to Mr. X resident on which tax was not deducted. It's a 40A subsection 1A. In case of TDS violation on any payment, then 30% of such expenditure shall be disallowed. Disallowed. Interest on loan. Adjustment number 10. 30% disallowed. Have you understood? These are the adjustments relating to total income problem. So I don't want to explain the entire answer. I give you directions how to solve this problem. First of all, should calculate the income as per normal regular rules. And second one, so AMT calculation shall be made. If assessee's actual income is less than AMT, then compulsory he is required to pay tax to the government. AMT is payable to the government. So first apply AMT provisions. So if regular income tax is less than AMT, then AMT is payable to the government. Then after that, calculate the income under optional scheme and compare the regular income and optional scheme, AMT and optional scheme, and whichever is beneficial to him shall be taken into account. Have you understood? So I show you the answer, how it was calculated. 13. This is the computation of total income of Kamal, PGBP, business income. This is the specified business, 35 AD business taken separately. 35 AD business. PGBP, income from other sources, interest on income tax refund, gross total income, deductions, contributions to political party. This is the total income. As per normal rules, it includes 35 AD. So, and after that, calculate the total income based on the AMT provisions. in AMT, the assessee is not eligible to claim 35AD deduction. Then 35AD business is eligible only for depreciation. 100% deduction is not available. Tax liability on regular provisions. Regular provisions is nothing but regular total income, 31,33,620. On that, calculate the tax liability. This is the tax liability as per regular. And compute the adjusted total income and AMT calculation. Revise the total income by using AMT provisions. Difference between normal income and AMT is 35AD business is eligible for 100% deduction in normal provisions. In AMT, 35AD warehouse is only eligible for depreciation. Therefore, the total income shall be revised. The revised total income will be treated as adjusted total income. And that AMT rate will be applicable. AMT rate is 18.5%. This is the revised total income. Normal total income is 35AD income was revised. Therefore, the revised total income is equal to revised tax liability under AMT. AMT rate 18.5%. Since the regular income tax payable is less than the alternative minimum tax payable, so therefore assessee's total income is AMT. Assessee's tax liability is the AMT because AMT tax liability is less than regular income tax payable is less than the alternative minimum tax payable. Therefore, the adjusted total income shall be deemed to be the total income. Adjusted total income shall be treated as deemed to be the total income. Therefore, AMT is the tax liability. That and now solve this problem based on 115 BAC optional scheme. After that, tax liability under optional scheme shall be compared with AMT and whichever is beneficial to assessee to be considered. That's the computation procedure. Next one, give you most important information. Recently, the ICAI released a statutory updates. Some statutory updates released by ICAI recently. Compulsory every student must prepare those those points covered in statutory updates released by the ICAI. So, Masterminds management also going to plan to release those updates to the students and making videos on that. So, most important in those updates, there are very important some updates available in recent November examination, applicable to November 2022 examination. So every student compulsory prepare the latest statutory updates released by ICAI. Mainly, there are so many of important updates released in TDS chapter and return of income chapter. Most important. In 139 subsection 1, some more persons was added to file the return of income. Generally, there are 3 special cases involved in such section: electricity bill related case, foreign trip related case, deposit 1 crore in a bank related case are required to file return of income. In addition, that some more persons was added in that list to file the return of income mandatorily under section 139 subsection 1. That's the most important update. Okay, so compulsory every student must prepare. So next question number 14. State government of Madhya Pradesh grants release of coal mines to ABC Limited on Indian company on 1/10/2021 and charged 8 crores for the lease. So lease. This is a TCS provision. TCS 206C1C. So TCS provision, leasing, licensing, and contract. In these 3 payments, the recipient of the payment is liable to collect TCS at the rate of 2% in addition to consideration. TCS, there was a section, TCS section involved in this point. Next one, ABC Company Limited sold coal for 2 crores to Mahapower Limited, another Indian company, during the previous year 21-22. Mahapower Limited furnished declaration ABC Company Limited that the coal is to be utilized for the purpose of generating power. That's the most important. Here also TCS section 206C1 gets attracted. 206C1 contains some products, alcoholic liquor, coal, tendu leaves, forest leaves, forest products, timber obtained from forest products. There are so many of products covered in 206C1. Out of that, coal is one of the product. On sale of coal, the seller is required to collect TCS under section 206C1 at specified rate. Here, second transaction. First transaction 206C1C. Second transaction 206C1. So both are TCS sections. So one is mine, leasing of mine, lease of coal mine, leasing, licensing, contract, covered in separate section, sale of coal, covered in separate section. But here is one of the important point is, so leasing coal mine is subject to TCS under section 206C1C at the rate of 2%. It's a mandatory. But in second transaction, coal is subject to TCS under section 206C1 at the rate of at the specified rate. But there was an exception in that section. The exception was given. Those type of exceptions were given in statutory updates. So please prepare the statutory update. This point was covered in statutory update, where the buyer purchased the coal for the purpose of generating power. Then such sale of coal is not subject to TCS. TCS provisions not applicable in that case. 206C1 does not attracted in such case because the buyer acquired the coal for purchasing, for utilizing the generation of power, and he submits a declaration also to seller. He submits, so the buyer submits a declaration to seller for procuring the coal for the purpose of generating the power. Therefore, 206C1 does not attracted. Seller need not be collected TCS under section 206C1. That's the one of the exception to section 206C1. So that's the important point. It was not in your material, but it was covered in latest study material, latest updates released by ICAI. That's why this important problem in upcoming examination point of view. And one more important point, what 206C1 does not attract it, but TDS provision gets attracted under section 194Q. 194Q says that sale of any product exceeds 50 lakhs, then the payer is subject to TDS under section 194Q. So 206C1 does not attract it, but 194Q gets attracted here. That's the important point. 194Q says that where the transaction was covered in 206C1, then TDS provisions not applicable under section 194Q. Where the cases were not covered under section 206C1, then such sale transaction was covered in 194Q, then the payer is subject to TDS under section 194Q mandatorily. Here TDS provision gets attracted. So there are two transactions in this. The first one is leasing of mine subject to TCS under section 206C1C. Second one, sale of coal for the purpose of power generation. Therefore, such transaction is not covered in TCS provision. Whenever the transaction was not covered, then it will be automatically covered in 194Q section. Okay, so please verify. Please verify the answer. 14th one. First transaction, leasing of mine. Section 206C1C provides a collection of tax at the rate of 2% by every person who grants leasing of any mine or quarries. So at the rate of 2% on 8 crores, 116 lakhs. So next, second transaction, sale of coal. Under 206C1, seller of certain goods, coal is required to collect TCS at the rate of 1. However, no collection would be made under section 206(1) in case of resident buyer if such buyer furnishes to person responsible for collecting tax declaration to the effect that the goods are to be utilized for the purpose of generation of power. This is the statutory update released recently by the ICAI. Please prepare, most important in examination. So 206C1 does not attracted, then it will be covered automatically under section 194Q. Then the buyer is required to make the TDS on such amount. So in the present case, ABC Limited, is not required to collect TCS under section 206(1) in respect of coal. So next, as per section 206C1H also not applicable here. 206C1H says that sale of any goods, those not covered in 206C1. 206C1 coal was covered in 206C1. Therefore, 206CH does not attract it automatically. Just ignore it. But here is 194Q gets attracted automatically. 194Q says that sale of purchase of any goods exceeds 50 lakhs, then subject to TCS, subject to TDS under section 194Q. So as per section 194Q requires any payment being buyer who is responsible for paying any sum on resident purchase of any goods of the value exceed 50,000, deduct tax 0.1% 50 lakhs. Provisions of section 294Q does not attract in those transactions where tax is collected under section 206C, except 206C1H is nothing but 206C1. Next, buyer means a person whose turnover in preceding year 10 crores. Yes, in this problem, this condition was satisfied. In this case, since Mahapower Limited turnover in 2021 exceeds 10 crores, it is buyer as per section 194Q. Since tax not deducted under, not required to collect on sale of coal to Mahapower Limited, the provisions of 194Q would apply, and Mahapower Limited is required to deduct tax at the rate of 15,000 under the 194Q being 0.1%. Where 206C1 does not attracted, then there may be a possibility of applicability of 194Q. But 206C1H does not attract it to those products covered in 206C1. So because 206C1H having a provision, that is, this section is applicable to all other products, those not covered in preceding other TCS provisions. So the products covered in 206C1 does not covered in 206C1H. 206C1H is applicable to sale of any other product, those not covered in other TCS projects. So the possibility of applicability of 206C1H does not attracted here. Okay. So next, last one. So I think this is one of the important problem in this upcoming examination point of view. And 15th one also written filing related, also very important. 15th one, Mr. Vikas is resident in India, 80 years, having a house property of Mumbai. He has let out at the rate of 50,000 per month from 1/4/2021. He does not have any other source of income. Is because required to file return of income. Also an important problem. So generally the rental income is subject to TDS. The tenant is required to make TDS under section 194I if it exceeds 2,40,000. So that's one of the important. But here is written filing 139(1) says that the persons are other than company firm are required to file return of income only if the total income exceeds basic exemption limit. Otherwise, no need. But here the assessee income is rental income only. Rental income is nothing but 50,000 into 12, 6 lakhs. Out of that, 30% is the standard deduction. Therefore, taxable portion only 70%, 4,20,000. Not exceeding basic exemption limit. Generally not exceeding basic exemption because assessee age is 80 years. Basic exemption 5 lakhs. Here the rental income not exceeding basic exemption because assessee is not having any other source of income. So his total income is income from house property only. That too only 4,20,000. It was not exceeding basic exemption limit. Generally not liable to file any return of income under section 139 subsection 1. But latest statutory update released by the ICAI, some more persons added in such section 139 subsection 1 to file the return of income on making some specified transaction. Out of that, one of the transaction is the person who has made the who has paid or collected TDS or TCS more than 50,000. Then he is required to file return of income irrespective whether they are having the income or not. Irrespective of the income, they are required to file return of income. But here, compulsory the assessee satisfied such condition. So please verify the answer. Generally, as per existing provision, not liable to file return of income. But As per latest statutory update, compulsory is required to file return of income mandatorily. Please verify the problem. An individual whose total income, this is the existing provision. At present, assessee's total income, class 7th provides that a person who is not required to furnish return of income under section 139 has to furnish return of income on or before the due date specified. Accordingly, in notification released in 2022, so CBTT inserted Rule 12B. This is the new Rule 12B, which was that in case of resident individual who is 60 years or more at any time during the previous year is required to file his return of income if aggregate of tax deducted at source and tax collected at source. In his case, during the previous year, 50,000 or more. Tax deducted at TDS and TCS, aggregate amount if exceeds 50,000, then he is required to file return of income. So, in this case, Mr. Vikas' total income would be comprising of only income from house property, from let out property. The total income is 4,20,000. So, which is below the basic exemption limit. ABC Limited required to deduct tax under section 194I at the rate of 10%. That is 6 lakhs into 10%, 60,000. Since the TDS amount is more than 50,000, he has to furnish return of income for the assessment year 20 on or before the due date specified under section 139 subsection. This is the main provision, important. Have you understood? So I think last 2 points, last 2 questions are last 2 questions includes the latest updates released by the ICAI. So must prepare by every student. Last 2 questions, mandatorily important. And total income problem is also some important calculations are there. So most beneficial method, whenever the problem contains a question related to most beneficial method, then you should require to answer the question in both normal as well as optional. Whenever the problem contains 35 AD, 10 AA and chapter 6C heading C benefits, then automatically the problem will answer under AMT also, even not specified in the problem. That's the most important observation. Okay. So thank you all of you.